Hi, this is Wendy from HMO Success. And today's video is all about whether you should invest in stocks and shares or property. So, as an investor myself, I can completely understand the dilemma that you might be facing right now. You might have a pot of money to invest with, and you're wondering, should I invest in the stock market or should I invest in property? Now, the two different classes of assets are really quite different. And today what I wanted to do is share with you the three differences between those two assets so you can make up a decision for yourself, an educated decision about what's right for you. Now, before I start, I must just say I am not a financial advisor. I'm not here to advise you personally. So any choices you take as a result of this video are down to your choices and yours alone. But what I can do is share with you my experience and my knowledge, and hopefully that will help you to make a more educated decision about which direction you want to go in. Whichever asset class eventually you choose, it's really good to be educated, and I'm sure you'd agree that actually learning how to do this is by far the best way to make any asset really give you a good return on your money. Now, let's imagine you had £100,000. That would be rather nice, wouldn't it? And you decided to invest it in stocks and shares. And if you could invest in a wrapper, maybe like an ISA, which is a tax efficient wrapper, so that all the gain would be free of tax, you could potentially make quite a good return. Now let's imagine you made 7% return. So you've made £7,000 from your £100,000. That equates to a 7% yield. Not bad, you might say. But of course, with property, the difference is that you can leverage that money. So you could buy a property without a mortgage and you could rent it out for £7,000. That would be exactly the same yield, 7%. But instead, what if you use that £100,000 to buy two properties? You put £50,000 in one, £50,000 in another, and you had a mortgage of £50,000 on both of those properties. You would be what we call 50% leveraged. You would have a 50% borrowing on either of those properties, on each of those properties. Now, let's say you rented out each of those properties for £7,000 a year. You would get £14,000 income. You'd double your income. But hey, I know what you're going to say to me, but Wendy, what about the cost of servicing the mortgage? Absolutely, and we have to bear that in mind when we're looking at the overall return. Now, at the moment, interest rates, as you know, are very low, so it's actually very cheap to get a mortgage right now. And it could cost you as little as maybe £1,000 a year to service a £50,000 mortgage. So again, let's do the maths. So you've got two properties, each worth £100,000, each with a £50,000 mortgage on it, each of them taking in £7,000 a year rental income. But out of that £7,000, you have to take £1,000 per property because of the mortgage payment. That means overall you get £12,000 income. So that is a 12% return. So can you see how by leveraging your asset, and this is the benefit of property, you can make a lot more money long term. Now, of course, there are other costs, aren't there? With a property, you have to manage it, you have to service it, there might be maintenance, there will be insurance, there'll be other costs. So it's not as simple as just taking the mortgage off. You've got to bear in mind all the other costs, and they could be as much as another £100 a month. But because of the leverage position, this allows you to make the most of anything that you put into that property. The other benefit of property is you don't have to find the full £100,000 to invest with. So let's say you only have £50,000, you can start with £50,000, borrow £50,000, and you have a £100,000 asset. Unless you take out a loan to buy stocks and shares, the only way you can do that is using your cash. And in fact, most people invest in the stock market with their cash. So we've talked a little bit about income and what returns you can get. The second one, though, is capital growth. Now, housing is very much related to inflation. If you look at a chart of inflation over the last 20 years, you'll see that roughly house prices grow in line with inflation. So they're a really good inflation-proof asset. So what are the things you've got to look out for? Well, number one is interest rates. Now, at the moment, we're in a low interest rate environment, so it's actually a really good time to be borrowing money because it doesn't cost a lot of money. But if interest rates were to go up, you'd have to bear that in mind in terms of your profitability that you're making every month on your property, because you'd be spending out more to service the mortgage. But of course, you can also put the rents up. So long-term, property will always make money. But you just have to be aware of this indicator, the interest rate indicator, to check that you are making money every month on your property. The second thing to think about is tax. Now, when it comes to property taxes, the UK government have made it really complicated, particularly if you're a higher rate taxpayer. Now, I can't go into all the whys and wherefores on this video today, but what I can say to you is either get some independent individual financial advice to help you in your personal and particular tax situation, but one of the best pieces of advice that I've heard is to invest in a limited company. Doing it that way protects you, it protects the portfolio that you'll be building, and generally it's deemed to be the most efficient way of investing to save yourself the most amount of tax. But again, I would recommend you get personal advice on that particular one. Now, the other part of tax is capital gains tax. We have a rule in this country that if you make a gain on your capital asset, whether that's property or stocks and shares, and you come to sell it, it's called crystallising the gain, that you will have some tax to pay. Now, every year the government gives us an allowance, which I think is about £11,000 at the moment, to allow us to have that £11,000 without paying tax. But after that, you'll have to pay tax. Now, when it comes to the stock market and stocks and shares, using an ISA, an individual savings account, is usually the best way to do it. That is a tax wrapper, and that allows you to earn money and income, and also to benefit from capital growth within a tax wrapper. So in other words, you're not taxed on that growth of that asset, which is a really good way to invest. And then the other part of the equation, of course, is your own time, effort and energy. How much do you want to learn about these asset classes? How much are you prepared to put your time and effort and energy into learning about it? And how much do you want to leverage that? Personally, I like to have a mixture of both. So I've both got properties and a property portfolio, but I've also got a stocks and shares ISA. And I use that to invest in the stock market where I see a good bargain or I see a company I want to invest in. But I have spent time educating myself, learning about these asset classes so I can make the most of my money and grow my wealth. I hope you do the same, and I hope this video has helped you. I'll speak to you soon.